Hello, Ms. Koch. Thank you for joining us today.
It's my pleasure. Thank you for having me.
This stock market has seen quite a volatility these days. And how do you interpret the causes behind this recent market turbulence?
It is true that this year there's been more volatility. And I think the market is telling us that the outlook is more uncertain for the rest of this year and for the medium term. And so you asked, how do we explain the volatility? There's two dynamics I would point to. The first is that we know that the U.S. equity market is very concentrated into a small group of companies.
You mean like tech stocks?
Tech stocks, exactly. And many of those stocks had appreciated on the back of the AI or artificial intelligence theme, particularly over the last couple of years. As we know, that theme was fully priced in, and there are some questions around demand for some of those companies on the back of cheaper alternatives to AI coming out of Asia, and that put some downward pressure on those companies. I do want to say that we think that this is a secular theme, artificial intelligence. At TCW, the company that I have the privilege of running, our global asset management company, we've been investing in AI as a theme for 10 years. And we think that there is many decades to go in this theme. We're in the early innings of it. But it is very possible that in the short term, it may underperform as people are trying to price out exactly how much demand is going to be there. So that's one thing that's weighing on U.S. markets, this AI underperformance in this small group of companies. Actually, most of the underperformance for the U.S. market has either come from that group, technology, or consumer discretionary. So the consumer is under some pressure, which I'm going to come back to. But other sectors in the U.S. market have actually posted positive return. So a lot of this is about the concentration in technology, exacerbated or worsened by some underperformance in the consumer. So that's weighed on markets. And the second thing I wanted to comment on was just general macro weakness. And we have many signs that the U.S. economy is slowing. That has put pressure on earnings estimates, and that has put pressure on equity markets. I want to end by saying, while there's been some near-term underperformance of equity markets, valuations are actually still pretty demanding for equity markets in the U.S. And so that leads us to what your viewers are probably most interested in, which is this a good time to own or buy U.S. equity markets? And my answer to that is that I continue to think that the U.S. equity markets are a good place, a good destination.
In the long term?
Yes, for capital, but in the long term. And valuations are not cheap. So people need to be aware of that. And we think volatility will persist. So security selection is going to be very important here, and hunting for opportunities broadly. And we would highly encourage people to look outside the index, because the index is so concentrated in that small group of companies and that one theme. We think clients would be much better served to approach the market actively and look outside of the top companies into other sectors, into other parts of market capitalization, potentially smaller companies too, to get the best opportunities.
You mentioned we need to focus on the other sectors beside the tech. So could you name some of the sectors that we need to focus on?
Yes, so for one, some themes that we like would be in the energy transformation in the U.S. market. As well as companies linked to supply chain transformation, which we know that we're trying to nearshore or reshore supply chains in the U.S. because of fragilities revealed during COVID. And now with the tariff situation, it's also going to cause further disruption to supply chains. So hunting for interesting companies that are going to be part of the energy transformation in the U.S., because we know that there's going to continue to be very strong energy demand to power the AI revolution, as an example. And then also looking for companies that will be the beneficiaries of the changing supply chain, which would include companies in the industrial space. Those are all parts of the market that we're actively hunting in. And we have dedicated portfolios focused on those themes, the transformation of the energy system, as well as the transformation of the supply chain in the U.S.
And as you mentioned, over the past decades, the U.S. stock market outcome compared to other global stock markets. And some says that as the U.S. exceptionalism. Do you think that can last in other decades too?
I think that, again, the U.S. is going to be a very important destination for capital. There's high levels of innovation, and the capital markets are the deepest in the world. There's obviously a lot more companies staying private than going public, so that's a dynamic to be aware of. But yes, I think it is possible that the U.S. can continue to be one of the most attractive destinations for capital globally.
Okay.
At the same time, people have high allocations already to the U.S. market.
Yeah, that happens in Korea.
Yeah. Oh, a lot of investment.
Yes.
Yeah. But if you look at the U.S. as a country, the U.S. is less than 10% of the world's population. It is 20% of global GDP, and it's 70% of world's equity market capitalization.
Yeah.
So one might argue that it's already very well represented in global equity benchmarks. I conclude by saying I do think clients should continue to invest in this market, but I emphasize again that you want to be highly selective about what part of the opportunities to get, because valuations are demanding, because it already is a big part of global equity portfolios, and because we expect more volatility and disruption ahead, and active management can really help clients navigate that. And what I mean by active management is individual security selection over buying the index.
Okay. Then if investors want to look outside of the U.S. stock market, what do you recommend for them, like region or country?
We actually think there are some interesting opportunities in emerging markets equity. So there's two areas I would look to. Emerging markets equity is extremely cheap valuations relative to developed markets.
Okay.
And we do think that there's going to be interesting opportunities for growth there that are highly diversified from what's happening in the U.S. And so we like some of those opportunities. And then I would also say an area of the world that's been very overlooked is Europe. And this U.S. exceptionalism that you referenced before, and the current administration's focus on the United States and investing in the United States and protecting U.S. economic interests actually has been very galvanizing for Europe and for the U.K., and it has caused the Europeans to invest more than they have historically. There's a very recent example of that with Germany investing in the defense sector. We think actually some of these dynamics happening in the U.S. are a positive catalyst for Europe from a growth perspective, really awakening the Europeans and pushing them to make domestic investments that could benefit the equity market. It may not necessarily be positive for European sovereign debt because it's going to put pressure on the fiscal side of the equation, but it could be interesting and continue to unlock value in European equity markets. So you have a growth pulse, and you have the fact that European markets across the board are cheaper than U.S. markets. So if you ask me where I would look outside the U.S., it would be to Europe, and also, you know, again, all bottom up. Parts of the emerging markets too.
And as you mentioned before, there's a talk that U.S. economy is now slowing down a little bit, and some mentioned there could be a recession within a year or so. So what's your opinion about that outlook?
I think it's impossible to tell people exactly when there's going to be a recession, but I would say that you're accurate in that there is slowing happening in the U.S. economy. I would also say that we believe in business cycles, and we're at the more mature part of this business cycle in the U.S. Something important for Koreans to know about the U.S. economy, because it's different from Korea, 70% of U.S. GDP, more than 70%, is driven by consumption in the United States. And the top 10% of consumers by wealth segment drive 50% of the consumption. So the only way to get a recession in the U.S. is to have a lot of downward pressure on the consumer. The bottom end consumer in the United States is already in a recession. That consumer has demonstrated recessionary behaviors with across many sectors. In the top end of the market, we are just starting to see weakness in that consumer. So the airlines in the U.S. came out and warned that profits could be weaker, and some higher end clothing companies and
Luxuries.
restaurants, not even luxury, affordable luxury even, and restaurants have warned that demand is weakening. And so I would say that we are starting to see weakness in the consumer for the first time since COVID, which was very brief, right? Because then we sent out checks to everybody and they spent money. That solved that problem. But we're back to the regular business cycle, and the consumer does appear to be extended on a few metrics. And so we're watching that very closely. Employment is still pretty healthy. But the actual unemployment numbers, a lagging indicator of this recession that you're talking about, you actually start to see the weakness show up first in the quit rates and the hiring rates, and those are getting weaker. So we got to watch employment, and then I also would watch back to the equity market. That top 10% of the consumer that drives 50% of consumption, it's the same cohort that owns a big chunk of the U.S. equity market. The wealthiest people in the U.S. own a lot of the U.S. equity market. So if you see a sell-off in the equity market, it will hurt consumption patterns of the top earning consumer in the U.S. Pulling all that together, we think that we believe in business cycles. We think we're later in this business cycle. We're watching the consumer very closely. We know that the low-end consumers already had struggled. We're starting to see some signs of weakness in the high-end consumer, and it's giving us a lot of caution. The other part of the market that is under some pressure is just general capital expenditure from companies, because we have this very volatile policy environment and a lot of uncertainty on the macro and around tariffs. And as a CEO, I run a company. I make investment decisions too. It's a tough environment to make long-term investment decisions when you're not exactly sure of the trajectory of the policy environment and also of growth. So there's going to be delayed spending from that perspective too. So again, I lack the crystal ball. I can't tell you exactly when it's going to happen, but we do see a tougher environment ahead. And I want to end by saying the thing that makes it the most challenging as an investor is that valuations, we talked about them being pretty expensive still in the U.S. market. They are the credit spreads, which is the way you think about valuations in the corporate credit market, are very tight, which means that credit's pretty expensive still too. And so when we think about how we invest at TCW, we are underweight the credit markets in our portfolios, because we think that this volatility will eventually cause spreads to widen, and that will be a better opportunity to own more credit. So environment is weakening. Valuations haven't adjusted yet. Yes, there can be investment opportunity to take advantage of here, but just like in equity markets, you're going to want to be very selective and very active in how you navigate the bond market.
Okay, that sounds like it's going to be really tough to invest in the future.
The reality is that environments like this, where things are changing, where the interest rate environment may be changing, where the macro regime may be changing, where the policy is uncertain, it just creates a lot of uncertainty and it creates volatility. And actually that can be an incredible investment environment, but you have to be selective at the security level, be very deliberate in what you want to own. And I would say being with a manager that can keep you liquid and can keep you conservatively positioned. And then when these opportunities present themselves, you step in and be a liquidity provider when other people can or won't provide liquidity. That is one of the most time-tested ways to create a lot of wealth.
So some says that after Donald Trump back to his political stage, there's huge political uncertainty was rise. Some believe his tariff policies will not just slowing the economy, but will pushing up the prices in U.S. economy, but inflation and the slowing down at the same time, like some call stagflation.
Right. Inflation, by definition, is a continuous upward pressure on prices. A tariff is a one-time reset, so it's like a tax, but it's not necessarily continuously impulsive to continuously putting upward pressure. It's a one-time reset in prices. So it's not inflationary necessarily, but it does make a one-time price increase. What I would say, though, is that that's not good when prices go up, even if it's a one-time reset. That could put pressure on the consumer. The other probably more important point is around Fed policy. The Fed mandate, first and foremost, is to control for inflation. I think there is a view by people in the market that tariffs could be inflationary. I've just said I think it's more of a one-time price reset, but still prices will go up. I think they're worried about how that will transpire. And therefore, I think it's likely, or we think it's likely, that the Fed is going to keep rates higher for longer because they're going to be very focused on attacking this inflationary impulse. And that poses potential risk to think about for the economy because policy is already restrictive. And if we keep rates higher for longer, that could put additional pressure on the economy. You're asking whether or not there'll be stagflation. I think it's too early to tell, but it is something that we have an eye on. In a stagflationary environment, all risk assets do bad. So that's not a great environment for investing.
Then how about other countries beside the U.S.? Like, how does the Donald Trump's policy affect to other countries?
Well, as we talked about, President Trump's focus on the revitalization of the U.S. economy and is actually, I think, positive for some other countries in that Europe is the best example we spoke about before, that they are going to focus on their own growth more, and we've already seen that in what the policy announcements are. But as to how it impacts the neighbors to the north and south of the U.S., I can't really say that till we know what the final tariff policy is going to be.
Let's move on to the fixed income side. And which segment of the U.S. bond market do you find most attractive?
So we are a $200 billion global asset manager. We have exposure to global fixed income markets. Our largest business is in liquid fixed income. We have equity market exposure, and then we also have alternative credit exposure on our platform. I would say like our unconstrained portfolios where we can go anywhere in liquid fixed income markets. Actually, we like the securitized markets most. So we would, agency, MBS, or mortgage-backed securities is the part of the market that we're most overweight because we can get conservative liquid positioning. We can get yield that is in excess, obviously, of cash. And then we're underweight the credit markets, which, as I said earlier, we find to be very expensive. And so that's our general positioning in fixed income. And so we like that unconstrained portfolio because, as I alluded to earlier, what it gives us the opportunity to do is to stay liquid, stay conservative, and wait for these dislocations to use that as an opportunity to buy credit exposure. Currently too expensive, but given my outlook, we think the market could get cheaper, and we want to be able to take advantage of that for clients. So that's how we're currently positioned. We think it's going to be quite dynamic for this year. The other place I would look for, and there's some availability of these products in Korea, we do think the alternative credit market is very interesting as well. And so private credit as well as asset-backed finance, some of those vehicles exist in Korea, and that gives some exposure to fixed income markets in a diversified way and opportunities that aren't captured in public fixed income markets.
In your view, what are the most important variables or risks that investors should focus on this year?
I think watching valuations is very important.
Valuations.
So if there's any takeaway from this discussion, it's the fact that the macro environment is going to continue to get more difficult. We feel pretty confident about that. And currently, for credit and for equity, valuations are very demanding. And so the number one thing to watch is when is the opportunity to step into that. And being with someone who can help you pick what that moment is, I think is very important. There are plenty of things to invest in while you're waiting, and we talked about those for us. The securitized market is a good place to be invested. We talked about how you get additional yields and also not a lot of correlation to credit. Cash, AAA CLO liabilities, there's many parts of the fixed income market that you can be in, get additional yield over cash, and in some places even over regular investment grade bonds, and wait and stay liquid and then pick up on these dislocations. In 2025, there is going to be an opportunity, in our view, to lean into dislocated assets in both the credit and equity markets. And you want to be with someone who has kept you conservatively positioned and liquid so you can take advantage of those opportunities, both in fixed income markets as well as in equity markets.
That sounds to me we need to really study a lot more about economic status around the world.
Yeah, I do. And I want to just leave people with the thought that we don't think that something catastrophically bad is going to happen. I used the term before. We're just likely to have a business cycle. It's actually healthy. And if you can navigate it appropriately, it's an opportunity to create wealth. And just be prepared to lean in and buy these assets when they dislocate and when, other people may not be willing to do it. That is, again, the most time-tested way of creating wealth for yourself.
Okay, thank you for having an interview with us.
Of course, it's my pleasure. Thank you for having me.